start recording. Yeah. Yep.
Perfect. So thank you everyone for being here today. I think it's the first conference, right, or the first seminar in this series. So it's really great to have here Charlie McClure, and who's going to be presenting the paper Non-Gaap Reporting and Investment. Anastasia is also in the audience, so she can also take some of the questions if necessary. The way we're going to run these is probably we'll let Charlie 3-5 minutes at the beginning, so without questions, and then he's happy to monitor when you raise your hand for questions, and he'll take those questions directly. If he doesn't notice that you've raised your hand, then I'll also be keeping an eye on that. You're also welcome to leave any comments in the chat if you don't want to particularly ask a question, but just leave some kind of discussion or comment, because also at the end of the seminar, there may be an opportunity to talk with the authors in a more informal way to also discuss some of your questions. So thank you very much, Charlie, for being here. So please go ahead, the floor is yours.
Great, well, thank you all for coming and listening into my talk. This is joint work that I have with Anastasia, who, as Bea said, will be helping bail me out if some of the questions get a little tough. And this paper, we're looking at non-GAAP and investment. So I think we can all agree that GAAP earnings isn't necessarily a perfect reflection of a firm's core earnings, and part of the reason for that is that GAAP earnings contains transitory items. Now, this can affect a firm's investment decisions because investors tend to use earnings when they're determining stock prices, right? If you think about like PE ratios and stuff like that. And if the manager cares about the stock price and investors are using kind of a noisy measure of earnings to help determine that stock price, those transitory items in GAAP reporting can have that feedback effect into and affecting the firm's decisions. Now, one of the ways that firms have tried to get around this issue of having an imperfect measure like GAAP earnings is through the use of non-GAAP earnings. It's a way for firms to adjust for transitory items that can possibly, make their investment decisions more efficient if they're able to if they're able to credibly communicate to investors a better measure of core earnings. So what we're looking at in this paper is how does this ability to report non-GAAP earnings affect firm investment, right? Non-GAAP earnings is a pervasive voluntary disclosure that's not without debate. On one hand, firms will contend that non-GAAP earnings can better signal core earnings and as a result increase investment efficiency. But on the other hand, it can also result in a biased measure of profitability. By definition, non-GAAP earnings is not subject to the measurement and recognition principles that's in GAAP. And so there's a lot of ability for managers to maybe be a little opportunistic in how they define these amounts. And as a result, if we're thinking about how that could influence firms' investment decisions, it could make them more inefficient because they're able to, instead of actually doing the hard work of making investments, they're just going to bias these amounts and just kind of make paper profits through their non-GAAP disclosures. So to just kind of give a little bit of background on GAAP, firms disclose their non-GAAP earnings typically in their earnings press releases. Even though non-GAAP earnings isn't subject to the measurement and recognition principles of GAAP, firms are required to reconcile their non-GAAP amounts with their GAAP equivalents under Reg G. And the reason why firms are going to go through the effort of providing these numbers and reconciling them with GAAP earnings is that, again, these are custom profit measures that are maybe more tailor suited to a firm's specific business operations and can help better reflect core earnings. However, on the other side of the table is standard setters and others will contend that, because non-GAAP earnings isn't subject to GAAP, it could be like the Wild West of how you define GAAP earnings. One of the critics will say that, hey, non-GAAP earnings is just net income before expenses. And so there could be a lot of opportunism in how these amounts are defined. So just to kind of illustrate how pervasive non-GAAP earnings is, here's just a plot of the frequency of firm quarters that report non-GAAP earnings. As you can see, it's steadily increasing over time. And in fact, in 2017, 97% of S&P 500 firms in at least one of their quarters reported a non-GAAP metric. So this is a really, really common disclosure, as most of us are aware. And obviously, because it's outside of the framework of GAAP, there's a lot of questions as to how accurate this amount is. So, I think if you actually look at the reconciliation, this is some data from Audit Analytics, you can see that the adjustments that are made to go from GAAP to non-GAAP or vice versa, isn't kind of a standard formula across firms. You can have recurring or non-recurring amounts that are getting adjusted, as well as cash versus non-cash amounts. If you just look at this category column, you can also see there's a lot of discrepancy, a lot of variation in terms of what's getting actually adjusted. Some of these may be non-cash, non-recurring amounts like impairments or tax adjustments. Maybe those are really indicative of, transitory amounts that are trying to get, flushed out of a profit measure. And maybe some of the more recurring cash amounts like cost of goods sold that's getting adjusted, maybe that's evidence of opportunism and how firms are actually defining these non-GAAP amounts. So just to kind of, help motivate why we're focusing on this feedback effect, this real effect, is there's, kind of empirical evidence to suggest that there is this complementarity between non-GAAP reporting and investment. So if you look on this left-hand graph over here, we're just plotting the, incidence of non-GAAP adjustments, which is just, the difference between non-GAAP reporting, the non-GAAP earnings and GAAP earnings. And you can see that in periods when firms are reporting non-GAAP adjustments, that there's a significant increase in the amount of investment. I want to point out here, investment in this paper, we're going to be looking at intangible investment, and I'll talk a little bit about why we're focusing on the investment in intangibles. But what you see here is with this inverted V shape is that there really does seem to be this complementarity going on, in the sense that when firms are providing non-GAAP adjustments to investors, that there seems to be, an increase in the amount of intangible investment. So obviously, kind of taking a step back, we're certainly not the first to be looking at real effects, and we're certainly not the first paper to be looking at non-GAAP reporting. There's a very large, empirical and theoretical literature that's looking at the real effects of accounting, and essentially, the conclusion is, at a 30,000-foot view, is that, accounting measurement and disclosure decisions and rules, do seem to have a real effect on firm behavior. If we're kind of stepping over to the non-GAAP literature, there's a lot of empirical work that's being done there. And in 3 bullet points to summarize, what the key takeaways there is, that non-GAAP reporting seems to be the focus of investors relative to GAAP earnings. So investors seem to really hone in on the non-GAAP amounts, and that there does seem to be this tension at play. There's some papers that find that non-GAAP earnings is really a way for firms to, reduce the noise in their profitability signal, which is, kind of like the good reason for why firms would want to disclose non-GAAP earnings. But there's also evidence that firms are maybe defining some of their non-GAAP amounts opportunistically. So there really does seem to be this tension at play when it comes to non-GAAP. So if you've read the paper, or if you know who the co-authors are, we're going to be estimating a dynamic structural model. So essentially what we're going to be doing is we're going to be taking a theoretical model and taking it to the data. And obviously, it's a little bit different than doing a reduced form approach, and it's important to motivate why we're actually doing that. And the big reason for that is observability issues. There's a lot of observability issues when we're thinking about the optimal level of firm investment, as well as non-GAAP reporting. We don't observe, the fundamental or the transitory shocks that firms face when they're thinking about their operations. The fundamental shocks are going to be, kind of persistent and related to the core business, whereas the transitory shocks are just related to the just the accounting signals being imperfect. And so if you look at, accounting statements and accounting amounts, you don't necessarily get a good sense there for why that is, or how much of a particular amount is related to the fundamental shock versus the transitory shock. We also don't observe the amount of bias in the non-GAAP adjustment. So if you think about, if we could do that and investors could do that, that would essentially trivialize a lot of the non-GAAP literature, but obviously we're not able to do that. We can maybe try to infer that by looking at certain adjustments that maybe seem a little extreme or egregious. But at the end of the day, it's really hard for us to separate that bias in the non-GAAP adjustment. And finally, we have to think about the manager's incentives. Managers, they provide non-GAAP earnings and they maybe bias non-GAAP earnings because they care about their stock price. Presumably, managers also care about the fundamental value of the company. And so, how do you separate when you see a firm decision? How do you separate these two things at play? I see a couple of questions. I'll take some here. Ayum?
Charlie, I have two questions about this slide. When I read the paper, I think it seems to be there's a 2x2 scenarios, persistent versus transitory shocks. And then there's a dimension will be like core businesses versus non-core, or fundamental versus non-fundamental.
Okay. Yeah.
And then, so like I think when I think about the FSA class, we tend to think about their, like, for example, manufacturing firm, but investing in a derivative contract. That derivative contract will be non-fundamental or non-core, versus manufacturing the physical goods will be their core operations. And then within the core operations, they can be persistent shocks versus transitory shocks. So think about COVID-19 supply chain disruptions can be transitory, can be resolved after 1 or 2 years, but maybe there are some persistent changes in customer behaviors or tax function that can be persistent. I think just when I read the paper, that got me thinking about, you seem to equate fundamental to persistent, and non-fundamental or non-core to transitory, but it seems to be that there are 4 possibilities.
Yeah, no, that's a good point. And, maybe in the paper, we haven't quite written it that way, but, we have that AR1 process of the productivity shock.
Yeah.
And so, in that AR1 process, it's not deterministic. So there are, it is getting shocked up and down, and there is that error term at the end. And so that's probably picking, the purpose of that kind of shock at the end there is to pick up like we'll call it transitory, even though we've defined it very specific. It's kind of picking up the kind of the white noise associated with the firm's fundamentals.
I think this is just a writing suggestion. I think that your AR1 process definitely clearly identify the persistent versus transitory differences, but doesn't really directly address what is core, what is non-core businesses. I know the motivation coming from a lot of the non-GAAP debates and then the SEC regulation, but I think that is kind of like the broader motivating question, but that doesn't really tie well with your AR1 procedure. It's just a kind of like minor writing.
Yeah, no, yeah, I appreciate it. And I will say that we don't have a persistent transitory shock, right? So if you think about that, it's really
it's just the AR1 left.
The cells of that 2x2 matrix in our.
Yes. Yeah. And the other thing is just clarifying question about the bias. So is the bias you have in mind is that the manager keep adding a certain dollar amount or markup to the earnings, or what exactly is, because I think if we just keep adding the same amount or same percentage relative to the truth, over time, I think we can estimate it using archival data without the analytical model, right? Or investors cannot do it as well, just according to kind of like some of the Stein 89 model. So what's really unknown to investors in terms of the bias?
Yeah, so what we have here is, so we're assuming, I'll put it in quotes, rational expectations, but the investors are never learning. So they're just looking at the current period's GAAP and non-GAAP earnings. but we don't have this notion of learning that, hey, you know, CEO Charlie is really, you know, kind of bad, and he's, you know, we can kind of infer over time how much bias he has. We don't have a notion of learning in here. So that is kind of one simplification that we've made. And I think it's something that we should probably acknowledge a little bit more as we start to revise it. But
I think that is consistent with your short-term oriented managers, right? Your investors seem to be very short-lived. The reason they don't have learning is that they don't even stay there after 12 months. So they just don't have any memory. Okay.
Yeah.
Thank you. Yeah.
Barrett?
Yeah, so that was a decent segue, because my question is also about this bias in the non-GAAP adjustment and how that kind of plays into your model, because I'm just trying to conceptualize what we mean by bias in a world where, like you describe, the firms have to disclose the GAAP number, right? And they have to disclose the GAAP number more prominently than the non-GAAP number. And then they provide a reconciliation. So I guess in terms of bias, you're talking about what items they exclude or don't exclude. And, you know, I'm just trying to think about how this plays out, because if I consistently exclude the same items, right, then I can argue that's not a bias. Now, if all of a sudden I one quarter say, yeah, we missed estimates, but excluding wages expense, we hit it, right? You know, like if I'm an investor, I can see through that pretty easily. So anyway, I'm not sure I have a great point here. I guess I'm just trying to prod a little bit more on this idea of what exactly is the bias that you think that managers have, and why can't investors kind of see through that?
Yeah, so I mean, I think I mean, we stay agnostic about, you know, precisely what type of inputs or, you know, adjustments that firms are not making in terms of bias. But I think what we have in our mind is, you know, maybe there's some, well, I mean, kind of a simple example of these, maybe there's some, like, you know, unrealized gains that are buried in some account on the income statement that we as investors wouldn't observe. And, you know, the manager's taking out, you know, adjusting out these one-time losses, but because that one-time gain, you know, because some unrealized gains are affecting, you know, some, you know, income expense amount or income amount that's not able to be inferred through the income statement, that would be an evidence of bias. So it's, you know, we don't have kind of like the whole income statement in our model. That would be really hard to do. But I think what we're thinking about here is that it's just these adjustments or the lack of adjustments that firms are making, right? They're maybe taking out all these one-time expenses, but they're not necessarily, you know, taking the other side of that coin and taking out the one-time gains.
That helps me. Yeah. So the crime's kind of omission rather than commission a little bit, in terms of I can't see what's in the big GAAP number that hasn't been excluded that maybe should have been, you know, to be treated consistently with what was excluded. Okay, that helps.
Yeah.
May I just add an example? So just kind of corroborating what Charlie just said. So essentially our bias in mind is including transitory revenues and excluding transitory expenses. And as you said, not all of the parts are perfectly observed by the manager, even in the real financial statements and in reconciliations. And one example is this adjustment that Procter & Gamble was doing, and it got mentioned in the comment letter from the SEC. And the SEC is essentially asking in the comment letter, why are you adjusting just for part of the restructuring expenses? And Procter & Gamble is essentially saying some of our restructuring expenses are recurring. They happen every year, and part of the expenses, we expect them to be transitory. So that kind of knowledge is not really in investors' domain. and even kind of SEC having all the information from the company, they didn't really see clear justification for adjusting just for part of the restructuring expenses. So this is that kind of split, that kind of private information is motivation behind what we have in our mind for the bias. So it's something that just cannot simply be inferred from the adjustment. And it is the case that in some cases, like in splitting the restructuring expenses, it's just no way to understand why one part is permanent and another part is transitory. Thank you.
Yeah. So
I think we also have a couple of questions in the chat. So maybe if we want to take those, so Thomas maybe first, and then Sikyong also has a question.
yeah, sure. So look at Suchong's
dashboard for re-audit.
Is the case that, so her question is regarding the previous picture, is it the case that investment triggers the non-GAAP adjustment? I'm going to, I'll plead the fifth there. We're not necessarily claiming that it's, a causal link here, in the sense that, just to go back to that previous slide here. So we're not necessarily claiming that that inverted V shape on that left-hand side is actually is caused one way or the other. We're just saying that there's this association.
Yeah, thank you. Empirically, there can be, empirically it can be association, not a causation, but when we outline the structural model is essentially a very explicit causal mechanism when the two decisions, the fact that you take an investment decision and you can also bias non-GAAP adjustment, kind of these two interact and sort of cause each other. So the structural model is fully causal model, but as Charlie said, what we see in the data can be just happening for some other reasons, but we are going to take a very firm stand on this. We will essentially say, we think this is the economic model which underlines what's happening in the data, and we will be taking this model very literally when we take it to the data, but at the same time, as many of you kind of have questions about it, there's many things which are not in the model. It's just kind of the big concern for us, whether you believe or we believe we captured the main forces behind the model. But the model would say the model is a causal mechanism. What's in the data, as Charlie said, maybe just associations. Yep.
And I think Thomas also had a question about this graph. So maybe Thomas, if you're in the audience, and can you unmute yourself maybe?
Yep, can everybody, can people hear me?
Yeah, perfect.
Okay, great. Yeah, I mean, it's basically just what's in the chat there. I was just wondering, I do some non-GAAP work myself. And so I know a lot of firms, this is a very sticky thing, like they do it, every quarter or whatever. And so when I see time since non-GAAP, it makes me think, are you just thinking about these sort of one-timers that do this sporadically, or because a lot of firms would have sort of, there wouldn't be any time since non-GAAP, because it's sort of like every single time they're doing it. So just wondered if you could comment on that.
So we're capturing both here, in the sense that, yeah, there are going to be firms that are, that do tend to provide non-GAAP earnings, almost all the time. I used to have a graph in here to show like the switchers. I mean, people that, sometimes occasionally provide non-GAAP is actually, not an insignificant amount, but this graph is capturing both.
Here we're also talking specifically about positive non-GAAP adjustments. And in the model, as you said, so the model is sort of closer to reality in the sense that in the model, we will have the manager always manipulate, always have some bias, but if the manager has the bias, the manager would essentially would provide non-GAAP adjustment. But in the model, we impose a threshold, which is 1 basis point of the capital. So the adjustment has to be sufficient in order to show up on the financial statements. But in these particular graphs, we are restricting to positive non-GAAP adjustments.
Yeah. So that's where you mean the non-GAAP number is higher than the GAAP number, correct?
Yeah.
Yes, correct.
So that, again, that's I think 85-90% of most non-GAAP in reality. It's pretty common, right? So I just think readers of the non-GAAP literature, like knowing that, like even on your previous slide, there's 97% of S&P 500 are doing this, right? it's just tricky to think about like what the graph is like. Is the graph being driven by the sporadic non-GAAP reporters or not? I just think that will be for people who've been in this literature a while. My guess is it'll be a question that'll come up. So that's it. Thanks.
But yeah, we definitely have switchers in the data, but as you said, most of the companies do it persistently. So here we're essentially requiring the non-GAAP kind of be sufficiently positive to document this relationship.
Yeah.
Thanks.
Yep. Okay, so obviously observability is an issue, and that's why we're doing a structural model. But one of the benefits of our approach is that we also get to, think about some of the policy implications. So we get to think about how firms would change their investment decisions under different hypothetical scenarios that we never see in the data. And I think that's really like the bonus for doing structural. We can compare how the observed amount of investment we see compares to the first best, where a manager is really there just to maximize the fundamental value of the company. We can also see how, managers would change their investment decisions if if all of a sudden they were no longer able to provide non-GAAP reporting. And finally, the third counterfactual that we're going to look at is what happens if we could somehow eliminate the bias in non-GAAP reporting? How would firms' investment decisions change? So in the next couple slides, I'll go through, kind of at a high level, the model, but just some of the key features of the model to kind of set the table. So we're going to use a standard investment model that's pretty common in economics and finance. As I mentioned earlier, we're going to be focusing on intangible capital here, not physical capital, intangible capital. One of the big reasons for that is that most of the investments into intangible are expensed. Right, so that's going to be important because essentially intangible capital is going to be directly affected by the transitory noise in GAAP earnings. And furthermore, it's much harder for us as outsiders to actually infer the value or the amount of investment into intangible capital. So it's a really, kind of nebulous, activity that firms engage in, but it's obviously quite important. So in this model, the manager is going to have two competing incentives. He's going to want to maximize the sum of discounted cash flows. That's going to be his fundamental incentive. And he's also going to care about stock price, which is going to be essentially the, investor's guess of what that fundamental value is given the signals. And based on these two competing incentives, the manager is going to choose a level of investment and how much he wants to bias the non-GAAP adjustment. Now, on the technical side, I think one of the really interesting features of this model is that we're going to have rational expectations of investors, in the sense that investors are going to receive GAAP and non-GAAP earnings, and they're going to assign weights to these two signals based on their expectation of what the fundamental value is. So, kind of thinking through what that means, if the market suspects that non-GAAP earnings is rife with bias, then they're going to put a lower weight on that. Conversely, if they think that GAAP is just a really crummy number of the fundamental value because it's full of a lot of transitory noise, they're going to shift away from that and shift towards the non-GAAP reporting. Ayom, yep.
Yeah, so I still have a question about why do you need to restrict your investments to intangible capital? Because I think that the original economic model that you can still model tangible capital, capitalize, and then have this accrual component that depreciation expense in your earnings. And then right now earnings simply just the cash flow. And then it just seems that the earnings, when we talk about GAAP earnings, it has to have some accrued component, right? And then I think the same argument for tangible capital is that you buy this machine, but whether the produced goods will be purchased by customers will be related to future revenue, still uncertain. That's why sometimes we have asset impairments. And that is, again, can be transitory shocks that firms need to write down, and that's related to the exclusion, right? I think a lot of arguments you have for intangible asset is not kind of like exclusive. It's also applied to tangible capital. I just want to know how difficult to actually incorporate that depreciation of the tangible capital in your earnings assumption. Yep.
Yeah, so we exclude, and well, so I guess the reason why we exclude tangible capital, on the practical side, is that it would make the model much harder to solve, in terms of computationally. Yeah. But if you actually look at, some of the economics literature, and if you kind of run some regressions of the interaction between intangible and tangible capital, kind of the relation between the two, amounts is relatively weak. So you can, so essentially the takeaway from the economics and finance literature is that, they're somewhat distinct in their, they're somewhat distinct in terms of like their effect on the firm's operations, but obviously, a more expansive model, in theory could incorporate also the decision to engage in tangible capital. And we've just elected to, not overcomplicate the model, by adding kind of another decision for the firm and another, amount of capital, but recognize that, yes, this same model could be applied to, to tangible capital.
Yeah, and just adding a little bit on what Charlie just said. So indeed, the literature which models investment and which considers both type of capital, physical capital and tangible capital, they were doing both ways depending on the research question. Some would consider it separately without any interactions. Another would consider the interaction, but in order to have an interaction term, they would have some specific functional form which allows for the interaction between physical and intangible capital. We're using Cobb-Douglas production function. When we use Cobb-Douglas production function, added physical capital as a second capital and added the interaction term, we don't really see significant kind of strong effect of the interaction between physical and intangible capital. If we assume the Cobb-Douglas production function, this is what we are doing, but it doesn't mean that in some different model, kind of including different effects, it's possible to model the interaction. And also the way to think about our Y, kind of our cash flows, this is essentially the more generic way to think about it. This is profit before intangible capital expense. So essentially everything, so the model essentially forced to put in, kind of to capture by this functional form, everything that we didn't model explicitly.
Yeah.
So it's not like it's omitted completely, it will just take it all and put it there. Thank you.
Thank you.
Stephen?
Yeah, a couple of points. First of all, if your argument is that you're expensing this intangible capital and that reduces your earnings, so you actually create higher earnings. You can always do non-GAAP earnings by adding back your R&D and maybe advertising, promotion, and brand building. That would seem to be a mechanism to do it. Here is what we're earning before we do investment, okay? So if you're trying to deal with this problem of the accountants confusing earnings with investment, that would seem to be the way to calculate your non-GAAP earnings. That's one point. The second point is, I don't follow these non-GAAP components, but sometimes I see a lot of them are write-downs of tangible assets on the balance sheet. So you can have the situation where a firm is moving away in strategy from tangible investment to intangible assets. So they're actually disinvesting, okay, at the same time they're investing. They're shipping off the property, plant and equipment to Chengdu or Vietnam or somewhere, okay, and they're investing in tangible assets. So this investment is the question is, what is the net investment?
Yeah, so you're totally right. If we go back to that, the amounts that are getting adjusted, a lot of them are related to write-downs of tangible assets, and that's okay. We don't necessarily want to focus on like the specific adjustments that are getting made, like R&D or advertising expense. I mean, we're interested more in like, okay, GAAP earnings has a bunch of stuff in here that maybe is going to muddle up the true signal of the firm's core operations going forward. And so this muddling, whether it's coming from write-downs of tangible assets or it's from like making some other sorts of expense items, whatever's muddling it up, we don't really care as long as the fact that it's kind of making it hard for investors when they look at GAAP earnings to infer what the core earnings are. So it's not necessarily like we care about the adjustments, and you're right. Like if they did, there's not a lot of firms that make R&D adjustments to try to, get a better signal. I mean, that's not necessarily true. Even if they did make these adjustments, that would lead to like a perfect measure of core earnings necessarily by just stripping out like R&D expense and advertising. Barrett?
I thought I had this more well formulated than now I feel like it is, but I had a thought somewhat along the lines of what Stephen was saying, because I was trying to look at the contribution and I was like, maybe this could help you in terms of like contribution and motivating why you look at intangibles, internally generated intangibles, because this idea of you're basically saying there's some extent of these internally generated intangibles where the debit should not be to expense, the debit should be to some kind of asset. And because the debit goes to an expense, it makes it harder for investors to discern what the real kind of long-term profitability is. So anyway, I thought the fact that that's been a subject of debate for quite some time could be a motivation for why you do that. But also, like, it's got me thinking, so instead of the implication for standard setters being, should we allow non-GAAP disclosures, one of the questions is, should we reconsider how we account for internally generated intangibles, and then Stephen said, well, you could just back R&D out and maybe that takes care of the problem, or maybe R&D is so prominent that they don't need to back it out because investors for firms like that are already going to be paying attention to how much that is. But anyway, I just wanted to offer that up because this got me thinking about that whole debate, and I didn't know if there was a way you could kind of weave that into what you're doing. Yeah, no, I mean, I think that, I don't know if we've had that explicitly written up, but I think that's a great idea because not only is R&D, not only is intangible investment, getting directly expensed, but you're right. It's just really hard for us to kind of figure out, okay, should this be expensed? Should this be capitalized, et cetera? And I think kind of the inability for us as outsiders to infer what's really going on for intangible investments at a lot of companies, I think, makes this question of, noisy GAAP earnings and biased non-GAAP earnings particularly interesting. Thank you. Melissa.
So I love your guys' paper. I'm glad to be here and listen to you present it. I just have a question for you. As you thought about this issue, all these comments about R&D make a ton of sense to me. Like, I don't understand, like, it seems like this is a logical place where non-GAAP makes a ton of sense, but like, we don't see that many R&D adjustments. And I just don't know, like, is it because there's some reason that it's precluded or frowned upon by the SEC, or is it just that managers don't do it? And do you have a sense for why? Because I feel like that's where we should see a ton of it, but we don't see very much.
So I guess one thing, now that I'm thinking, this is related to Stephen's comment. I think, even if firms excluded R&D in their non-GAAP, right? And, I guess we could argue, whether that's appropriate or not. I mean, it doesn't necessarily get us around the issue of like, right, there's still going to be noise in like how profits calculated. So yes, you would maybe get like a perfect measure of what this intangible investment is, but there's still going to be forces outside of this investment activity that's going to be affecting profit, right? You're going to have fundamental shocks, and you're still going to have transitory shocks in there. So even if you strip out and exclude R&D expense, it's not necessarily going to solve the problem here, because you're still going to have a lot of noise in the system that it's going to be really hard to disentangle from the productivity of a company that's going to have this, the productivity shocks that's going to be like persistent going forward. So I know I didn't, necessarily quite address your question. There's something that like kind of came up as you were asking. I was like, oh, that might be.
Well, but I think the motivation, right, for the paper is that we've got a disincentive to invest because of accounting treatment. And if you think about where do we have like a big, maybe a potentially a big problem with accounting is R&D, where we expense everything, even though we know part of that probably is ultimately an asset. But ultimately, we don't see a lot of companies doing that? Well, do you know, are there reasons they can't just add it back? Is that a disallowed? No.
I don't believe it's disallowed. I could imagine, I mean, it certainly wouldn't be disallowed, right? I mean, you see here that some firms do it. I could imagine certain investors would be like, okay, this
little shady.
It's a little shady. Like, why are you, presumably this is part of your core operations, investing in intangible assets, but yet you're excluding it. So I guess, one of the criticisms that I could imagine that could come up as investors would say, you're stripping out something that's an important part of your business. Why are you doing that? It's not necessarily giving me a good measure of what your core operations would be.
I think relevant to this discussion, now R&D, you've got it classified as a cash expense. Okay, well, I guess you pay wages to your scientists and so on. But I am told, I haven't gone through this, that a lot of this actually is depreciation on the plant, okay, on the labs and the machines and so on. And sometimes that's rapid depreciation because of the technology changes. So it's actually, and it's depreciation, it's an expense. It's an expense. If the labs are depreciation or the equipment's getting technologically obsolescent. So that's something to keep in mind.
Yeah, thank you. Okay. So let's dive a little bit into the model just to, kind of go through, just to provide some intuition for the model. So we're going to have 3 state variables. So these state variables help determine, the manager's decision. So the first state variable is going to be capital. That's going to be Q, and like all sorts of capital, it has a depreciation rate delta, and then a manager can fill it back up with with an investment amount W. The firm also faces this productivity shock, which is a AR1 process in natural logarithms. So this is going to be, a profitability shock that's related to the firm's core operations. And then the third component is going to be a fundamental shock, a transitory or non-fundamental shock, and that's going to be new pi. And that's going to be the part that's going to noise up GAAP earnings. So profit, as Nastia mentioned before, is going to be a Cobb-Douglas production function. So that's going to be essentially the profit before investment is essentially going to be a function of the amount of capital Q, the profitability or fundamental shock, as well as alpha, which is the productivity parameter. And that's going to just tell us how easily capital maps into profit. So the first signal that firms are going to produce and give to investors is going to be GAAP earnings, and it's a function of 4 things. The first is going to be Y, which is that profit that I mentioned before. The second component is going to be investment. As I said before, it's essentially, we're subtracting it out because this is intangible investment and those amounts get expensed. The third is going to be adjustment costs. So these adjustment costs essentially, the idea behind these is pretty common in these types of models, is that if you make a huge investment in your company relative to the amount of capital that you already have, presumably that's going to cause some disruption to the firm. Now, the sum of those first three components is going to get you the expected cash flows for the period, right? And that's going to be, expected cash flows or our notion of core earnings. Now, the fourth term is the reason why GAAP earnings pi, doesn't perfectly map into these core earnings. And that's just because of the non-fundamental or the transitory shock that firms face. The second signal that managers are going to produce is going to be the non-GAAP adjustment. That's just the difference between GAAP and non-GAAP earnings. And that's going to be a function of 2 things. The first component is going to be subtracting out that transitory shock. And then the second part is going to be the bias that the manager is going to insert into the adjustment to, obviously provide a more opportunistic definition of non-GAAP. And so what you see here is that non-GAAP earnings is going to be GAAP earnings plus the adjustment. And that's just going to be equal to D plus B times Q. And so what you see here is that, non-GAAP earnings is going to be a biased measure of the expected cash flows. Whereas on the previous slide, GAAP earnings is going to just be a noisy version. So you had this noise versus bias trade-off that the manager and investors are going to have to deal with. Yes, Ayon.
Charlie, I just have a question about what do you mean expected cash flow? So on the previous slide, you keep talking about in the paper, it's expected cash flow from the current period's activities. What does that mean? How does that compare to a realized cash flow, or what do you have in mind?
Yeah. So I'm saying expected cash flows as opposed to cash flows because I want to be clear that we're not assuming that this is cash from operations that you could just look from the statement to cash flows. The expected cash flows differ from that because the cash from operations is like the realized cash that you get for this period, but that's not necessarily going to reflect like all of the cash flows that you receive that are related to this period's activities, right? Maybe some of those are going to be the resolution of accounts receivable and stuff like that. And so even if cash from operations, that's not exactly what we mean. We're just saying like, look, the expected cash that you're expected to receive from this period's production and activity, what is that going to be? And that's not something that we can identify through the financial statements.
Okay. So let me kind of like re-clarify. I think what you have in mind is that the expected cash flow relates to kind of like the right you can collect, but that can be independent of whether you actually collected within this 12-month period or not.
Exactly.
And then kind of reflecting the contractual or fundamental activities.
Yes.
Because I think there's a kind of disconnection, I think, is for all the structural modelings. And later on, you are going to use the financial cash flow statements data to fit into this expected cash flow. And then that would be the one, whatever being collected during the period. And then actually not just related to this 12-month period, because there's some cash collection as it related to the previous period, right? Yeah.
Yeah, and so we do that. We do like the Duchow and Duchev like reshuffling, where we kind of, shift some of the cash flows forward and backward a period to try to noise up like the data that's getting produced by our model to help better match what we would actually see on the statement to cash flows.
Thank you.
Yep.
And maybe we also had a question in the chat from Jeremy about using a structural model. And Jeremy, if you want to maybe ask the question, is that okay?
That wasn't a question. I think we were talking about the intangible, which can you hear me?
Oh, I'm sorry, I'm having difficulty hearing.
We couldn't hear you, so I think you're muted now. I'll send it later. Okay, that's all right then. We'll let Charlie continue.
Okay. So, so kind of with these two signals, in each period, the manager receives this payoff, DM, which is going to be a function of the expected cash flow, D, as well as stock price. I had said earlier that the manager cares not only about the expected cash flows, but he also cares about the current stock price, which is going to be denoted by P. If there's one parameter that is kind of like the most important parameter in the model is this parameter theta, which essentially tells us the relative importance between cash flows and stock price. And then finally, this third term here, that's just going to be the personal cost of biasing non-GAAP earnings. Essentially, presumably, it's costly for the manager to lie, whether there's reputational concerns, etc. So as I had alluded to before, we're going to assume a rational expectations equilibrium in the sense that stock price is going to be a function of two signals that investors are going to receive, and they're going to try to rationally guess what the fundamental value VF is of the firm. So they're going to essentially weight these two signals, GAAP and non-GAAP earnings, assign these weights based on what their guess is of the fundamental value. And because we have an equilibrium here, we're going to assume that the manager can correctly conjecture what those weights would be. Yeah, I am.
I promise this is my last question.
No, this is good.
So I think when I read your paper, I started thinking about Stephen Terry's paper he presented a couple of seasons before. One naive and evil question to ask you is that, would you find a similar magnitude if you assume managers theta is 0? So like somehow there's no misalignment between managers and shareholders. Both sides want to maximize cash flows. Managers are not myopic, focusing on today's price. Because I think his model the same, and then I kind of feel like two papers using different accounting measurement means to manage managers, investors' expectation, but I think the sources of the suboptimal investment coming from managers are short-termism and measurement. Is that, yeah, is that how do we think about the takeaway from the exercise? Yeah.
Yes. Yeah. So actually one of our counterfactuals is going to set theta equal to 0. And then we'll look at how that, and that's going to be our first best scenario, because in that case, the manager in this, he has no incentive to buy. He's just going to be trying to maximize the discounted cash flows. And so in that case, so we have a nice comparison there between, what we see when he's somewhat myopic by having a theta that's greater than 0 versus what he would do if he's just trying to, he's altruistic and just trying to maximize the fundamental value of the company. Yeah.
Thank you.
Charlie, you have 10 minutes. I think
Okay.
most people will have read the paper, but just in case you want to manage this last 10 minutes and go straight to some parts of the paper or presentation.
Yep. No, that sounds good. So we're going to assume an S-shaped pricing function. So essentially, if you think about like the Freeman and C, like the ERC stuff, that there's it's not going to be a linear mapping between, the GAAP and the non-GAAP signals and stock price. We can see this in the data in the sense that, here we've plotted, the expected values and then the GAAP and the non-GAAP amounts. And what you can see here is that non-GAAP earning and the coefficient on non-GAAP earnings is much higher. It's statistically significant, whereas in the coefficient on the S-shape for GAAP earnings is positive but insignificant. So this is going to be the manager's objective function. So this is actually what the manager is trying to solve. He's forward-looking in the sense that he's going to choose a level of W and B, investment W and bias B to maximize his utility, which is the sum of the discounted current period payoffs that he's going to receive. So this is the Bellman equation that he solves. And to provide, a little intuition about the model in a couple minutes, I'll just kind of jump to some of the comparative statics. So let's just assume, to kind of set the table, that GAAP only is the only signal that investors are able to receive and use when pricing the firm. Unsurprisingly, when you have a large fundamental shock, the manager can invest more because, presumably the, capital is going to be more profitable going, in the future. Also, if you have a large transitory shock, as you see here on the right-hand side, you have a large transitory shock that's going to, the manager is going to be lucky and it's going to boost GAAP earnings. And so the manager is able to offset some of the investment that's going to be expensed through this, through this transitory shock, right? So this is a, kind of the standard intuition if they just receive GAAP earnings, right? High transitory shock, high productivity shock is going to lead to more investment. Now things change a little bit if you allow the investors to recognize both GAAP and non-GAAP earnings simultaneously. The productivity investment is going to be unchanged, but on the right-hand side, we're going to be looking, you can see that there's actually a negative relationship now between the transitory shock and investment. And so the idea here is that, by being able to observe both signals simultaneously, these two signals of GAAP and non-GAAP earnings are not only indicative of the firm's fundamental value, they also provide incremental information about the two signals themselves. And so what you have here is that when they're able to process both pieces of information simultaneously, investors are going to say, look, we know we have to put a positive weight on one of these two signals, right? Because both of them are positively related to the fundamental value. However, if they put, positive weight on both of them, the manager essentially has free reign to overinvest, to bias a lot, etc. And so what essentially the investors are going to do is they're going to say, look, let's put a negative weight on one of these signals to help try to rein in the manager a little bit. And so what they're going to do is they're going to put a small negative weight on the GAAP signal and have a positive weight on the non-GAAP signal, where that GAAP signal is negative is essentially going to essentially result in the manager getting punished for having a high transitory shock. And that's going to help bring down the amount of investment and also help rein in being very egregious in the amount of bias. And the reason why they're going to do that as opposed to putting a negative weight on non-GAAP earnings, it's essentially because, biasing is costly for the manager, whereas the noise that's coming through GAAP earnings is exogenous to the manager. It's just a function of like the accounting system.
Can I rebound on the question I was asking?
Yeah.
So I really find it's interesting, this discussion about intangibles. It's not really the focus of your paper, but as you mentioned, there is an implication here that some of the more persistent shock, which right now is not recognized in GAAP, you could calculate it from your estimates and say, from the perspective of the model, there is this asset component that right now goes through non-GAAP. And that would be one implication. Do you think that's taking too far from your objective, or is that something reasonable?
Sorry, I say it one more time. I missed the first part of your comment.
The component that is non-GAAP is currently not being recognized in the books, but you're measuring it. And so you're saying this is relevant to investors. And so what you could do is extract from the solution of your model this intangible component, which is currently not in the books.
So this model, ideally we could, like, if we took the model literally and the results literally, we could do what Jeremy just suggested. If we were able to have heterogeneity across firms, like have different estimates for different firms, but this is a model of representative firms. So the statistics that we get, like the amount of non-GAAP adjustments, it's for a representative firm that we actually don't have. We're trying to get rid of heterogeneity when we estimate the model, but we cannot say, oh, this firm, this is how much bias, this is the amount of good adjustment. Unfortunately, we cannot do that, but the Jeremy's idea makes perfect sense.
Yeah. Thanks, Nastia. So I guess I have a couple minutes, so I'll kind of jump ahead to just some of the results here, just to kind of, highlight a few of the important things. So when we estimate the model parameters, kind of the one key takeaway is that we estimate a theta of about 0.14. And if you do some back of the envelope calculations, what that means is that the current stock price based incentives are about 14 times more important than the incentives to maximize fundamentals. And you can think that's a lot, but it's essentially saying that the signals of profitability are 14 times more important than the actual profitability, because we have this rational expectation going on. We're also able to, kind of recreate that's inverted V shape in the sense that there is this complementarity between non-GAAP reporting and investment. So what that does is that suggests that non-GAAP reporting makes it cheaper for the manager to engage in an intangible investment. So that's kind of like the economic story behind our model. We do a bunch of splits, which I don't have time to talk about. I'll quickly talk about some counterfactuals. We do a bunch of counterfactuals where we do policy, changing the accounting systems and the manager's incentives. What we find is that when we have fundamental shocks, or when the manager is just trying to maximize fundamentals, investment goes down and the value increases. When we eliminate non-GAAP reporting, we see a significant decline in investment, but not much of a change in value. And when we eliminate bias, there's not much of a change of investment, but we estimate that the change in value is about 94 basis points, which means that the manager is being more efficient in his investment of when to invest. And so we estimate the cost of bias of non-GAAP biasing is about 94 basis points. So just to wrap up in the last minute that I have, so our paper is looking at the trade-off between intangible investment and non-GAAP disclosure. And we find that there's this complementarity going on. And we also, estimate that financial reporting has a significant effect in a manager's investment decisions. And part of that is because the manager cares a lot about stock price, far more than he does about just the fundamentals of the firm. If we had a little bit more time, I could show why, but essentially firms, they want to overinvest because essentially non-GAAP reporting makes intangible investment a little too cheap for the manager. And finally, that we estimate that the opportunistic bias in non-GAAP earnings results in about a 94 basis point decline in firm value because the manager is making somewhat inefficient investment decisions. So that's all I have. I just kind of want to plug the next event that's going to be on February 10th with Wakar and Ayung. That's going to be looking at the effects of ASC 606 on revenue recognition. Thank you so much for the comments. So on behalf of both Nastia and I, we really appreciate you guys coming here, giving us feedback on the paper to help, strengthen, the takeaways and everything. So thank you so much.
Thank you very much, Charlie. That was a